Now, welcome to our today's class, that is financial accounting. And today's class we'll be able to talk about the statement of cash flows, that is under the IAS 7. Now, statement of cash flows is a statement that shows the flow of cash inflow and cash outflow, meaning that in this case what we'll be basing on will just be basing on the actual cash inflows and the actual cash outflows. Now in this case also we'll also be able to talk about what we call the cash and cash equivalents. So the cash and cash equivalents are just the total, all the cash inflows and outflows. But for the cash inflows will be out of the receipts and the outflows is out of the payments. Now in this case, there are two methods that we'll be able to use. They are supposed to be used in presentation of the statement of cash flows. And number one is what we call the indirect method. Indirect method. And number two, we have the direct method. Now, in our case, what we'll be able to talk about in this case, we'll just talk of the indirect method. Direct method, we'll be able to run it more once you reach in financial reporting of section 3. So in this case, mostly we normally use the indirect method. Now, indirect method, this is now the format that you are required to use when preparing the statement of cash flow for the indirect method. And in this case, you have to start with the name of the what? The name of that company, that is XYZ Limited. Now, for the cash flows in this case will be divided in three categories. We will be having the cash flows from the operating activities, cash flows from investing activities, and the cash flows from financing activities. Now, for the operating activities, they are based on the routine decisions. That is for the operation of that company. What is making the company to gain the profit? Now, financing is as a result of what we call the capital expenditure or the capital receipts. Capital expenditure is now when you are selling the asset or when you are purchasing the what? When you are purchasing those assets. Now, on financing is on the relation to the sources of finance. That is generally the ordinary shares, the debentures, and the preference shares and so forth. That is what we'll be basing on. So in this case, you will have the statement of cash flow, statement of cash flows for the year ended 31st December. We can talk of a given year there. So as I've said in this case, you have to categorize the cash flows as I've said in 3. We'll have the cash flows. We'll have the cash flows from operating activities. Cash flows from operating activities. These are the ones that you need to start with. The cash flows from the operating activities. Now, cash flows from operating activities, in this case, you will have to begin with the profit. The profit before tax. You will have to start with the profit before tax. Then you will have to go to adjustments. Now, on the adjustments, remember there are those non-cash flows that have been included in computation of the profit before tax. Like for example, we know depreciation is a non-cash flow. The loss on disposal, that is as a result of capital expenditure which is supposed to be realized on the investment. So in that case, you will have to add such expenses back, like depreciation. In that case, we'll be able to add. We also have amortization. Amortization is the loss of value of the intangible assets like goodwill. So in that case, you will have that. Then again, we'll also have the interest expenses. Now the interest expense, remember, it is incurred on the debentures, and which in this case is part of the financing. So in this case you will have to add it here, then you go to less it on the what? On the financing activities. Then we'll also have the interest income. The interest income. Interest income is also what we call the investment income. Now investment income, in this case also, you will also be required to less that, it was included on that as income. So in that case, it's part of investing. We'll be also able to do it on the same. We also have the profit on disposal of the assets. All disposal. Profit on disposal is an income. So in that case, you'll also be able to less. And then there is also loss on disposal. Loss on disposal. So for the loss on disposal, in that case also, you will be able to add on the same. Then after that, you will also be able to go to what we call the working capital changes. The working capital changes. So working capital changes, in this case, is when we talk of working capital, is just the current assets minus the current liabilities. And therefore, the only items that we'll be basing on is the inventory, the receivables, and the payable. So in that case, you just look for the increase or the decrease. The increase stroke decrease in inventories. So if in this case it is a increase, you less. If it is a decrease, in that case, you'll be able to add. The same case to the receivables. You look for the increase stroke the decrease in receivables. So remember, these are current assets, and therefore the same case, increase you less, decrease in that case you add. And then the last one is on the payable. Remember, it's a liability. You look for the increase or the decrease in payables. So increase or the decrease in payables, in that case again, you look for the, if it's an increase, you add. A decrease, you'll be able to do what? You less. An increase, you add, because this is a liability, which is now the vice versa of what we've done on the current assets. So after that, what you get here is the gross cash flows from operating activities. So the gross cash flows from operating activities. Then after that, in this case, you can now less the tax that was paid during the year, the tax paid, and after lessing the tax paid, what we'll now be able to get here is now the net cash flows from operating activities. That is the net cash flows from the operating activities. So that is on the part of the cash flows from operating activities. So once you're done with the capital cash flows from operating activities, now you'll be able to go to the cash flows from financing activities, not financing but investing activities, from investing activities. The cash flows from investing activities. Cash flows from investing activities, I've said that the one that deal with the capital expenditure. And in this case, we'll have the sales proceeds from disposal of assets. Disposal of assets. In that case, you will have the value there. Then again, if there is also a purchase of non-current assets, the cash proceeds again from that purchase of non-current assets, in this case also, you will also be able to do what? To less, because once you purchase an item, remember it's a cash outflow because you are paying. Then we have the investment income, or what we call the interest received. Interest received. Now, the interest received in this case is this one that we were able to less it here. We less it because it is not part of the operations. Therefore, you're supposed to come and add it on the what? You add it on the investing. And after that, now in this case, you can get the net cash flows from investing activities. Investing activities. So we'll be able to get the value from that. So then after that, there is the last part, which is now the cash flows from financing activities. Cash flows from financing activities. Now, cash flows from financing activities, the cash flows from financing activities, that they are related to the sources of finance, and in this case, this is whereby we are having the ordinary shares and the debentures. So if in this case the company issues shares, the issue of shares, remember, once you issue the shares, you are receiving the cash. And therefore, in that case, you will add that value. Then again, there is also the issue of debentures. You issue debentures, you receive also cash. So in that case, if you issue debentures, you also add the same. Now, there is also loans borrowed. Now, for the loans borrowed, remember, you borrow a loan, you are increasing the cash, and therefore in that case you will add them. Then if there is loans that are paid, in that case, remember, you are paying out, so you less the loans paid. Then there is this interest expense. Remember, it's an expense that will be incurred on the loans, and therefore the interest expenses will also less them from there. My interest expense can also be the finance cost. And then the last one is now the dividend paid. Now, dividend paid in this case, they are paid to the ordinary shareholders or the debenture, the preference shareholders. Therefore, they are expenses that will be incurred on the financing. And after that, you can now get the net cash flows from financing activities. The net cash flows from financing activities. Now, after you get that, now you will also be able to get the net changes in cash and cash equivalent. The net changes in cash and cash equivalent. Now, for the net changes in cash and cash equivalent, you just take the net cash flows from operating, you add the net cash flows from investing, and net cash flows from financing. And then you'll also be able to add the beginning cash and cash equivalent, beginning cash and cash equivalent, then you'll be able to get the ending cash and cash equivalent. Be able to get the ending cash and cash equivalent. Be able to get the ending cash and cash equivalent. Now, how do you get the beginning and the ending cash and cash equivalent? In this case, you will be required to have what we call the cash and cash equivalent. Cash and cash equivalent. Whereby in this case, you'll be having the previous year, like for example, 2019 and 2020. So in this case, you only base on the cash and cash equivalent items. Whereby in this case, you can have the cash in hand. You will put the beginning and also the ending. Then we'll also have the short-term investment. The short-term investments. Short-term investment are also part of this. So you will also have the beginning and the ending. We'll also have the demand deposits. Demand deposits. We'll also do the same. You add them there. And then as at the end now, you can also have the bank overdraft, which this is a liability, and therefore in that case you less that and also less the same. So in that case, you will be able to get the values there. So in that case, these values that you get in this case, this is the beginning and this is the ending, of which when you take the net net changes in cash and cash equivalent, will be able to give you, when you add the beginning cash and cash equivalent, you are going to get the what? The ending cash and cash equivalent. Be able to get the ending cash and cash equivalent.